specific time frame has no support. And you could see here we have the black line that's sloping down well into the 28th, and it starts off at the level of around 1375 to 1377, and it comes down to an area at around 1371.50. So that happens to be that support area I was eyeing, which I was actually able to see last week. So far the trade is playing out as expected. Now, we should always focus on both sides of the market. We don't always, want to find the perfect trade that only moves in our direction. We want to look at where things could go wrong. And if we could actually identify trades where things could go wrong, happen to have strong resistance points that set up another trade that takes us to our objective, those are the great kind of trades, because it allows us to have multiple chances to re-enter a trade without having a great deal of new highs being made, and which basically means that your stop is not being taken out. Now, what would the stop have been, entering at 1408? Well, as I indicated before, any upward sloping lines act as resistance, and downward sloping lines act as support. So technically, when we made that high at 1408 and started descending down, we have a whole bunch of upward boundaries that are all converging to around the same levels. And you could see here those upper levels happen to be, 1420 long-term, 1418. But you got to remember one thing, that when we're actually identifying these critical resistance levels at the time where we actually identify a trade, this piece of the boundary condition that actually keeps on rising into the future is actually formed by the downward price action. So it's very important to understand that extreme events in the market or downside action forms the boundary conditions that give rise to future rallies. So at the time of looking over here, this boundary really only rose up to the 1411 to 1414 area, which I indicated last week. So that is where you would have placed a stop, okay? But right now, given that the market has come down, there happens to be some nice areas for traders in the event of a short-term rally after such a big drop today. There already was a bit of a rally, going into the end of the day for very short-term traders. What would be a level to try to reinitiate so that we could, come down to our next piece, down to that, 1377 area, or at least retest the lows, and head towards potentially 1371. And basically, if I zoom in over here, what you will see here is that we made a pivot low at around 1147 today at 1382.50. The market rallied into the period right now up to around the 1389.25 area. Okay, and just to keep in mind, in the S&P, every point is worth basically $50. And okay, so basically, depending on the number of contracts put on, it actually equates with a specific dollar value. So right over here, I'm basically looking for boundaries that happen to be sloped up. And what I see over here is I see an upward sloping boundary, this purple boundary that's sloped up, and it goes to an extreme at around 1394.50, okay? And then on the other side of it, we have some resistance at 1401. So I'd be looking at finding short-term sell trades in the 94 area to 1401, and I would actively, trade them down from basically those levels down towards the lows that we had today and towards those new levels. The key thing to look for to see if a trade is actually working is that when you're actually selling at those key levels, so for example the 1394 or the 1401, and what you want to do is you want to look at the conviction that the market has as it's coming down. So conviction would be related to volume. So I like looking at what was the maximum volume that actually took place on the downside break as we got down to our first objective. And when I look at this, I see a very strong downward black bar indicating a lot of price movement in a short period of time. And if I look at this bar, it showed 61,000 contracts of volume. In the next bar, when we had a small little retracement up before the next down move, we had volume of around 18,000. So volume dried up, which is normal after a big move. And then you want to see if higher volume even came in when the market makes a lower low. And you could see much higher volume came in. We had volume come in at 171,000 contracts on the downside compared to 151,000 on the upside, dwarfing the volume of 61,000 on the downside and 46,000 on the upside. That's one component that I look at. Another component I look at is I like to go back and look at what pivot points the market has actually made when the market tried to break up to get us to the objective that allowed us to get the sell signal. And you can see here, when was the last time there was a massive flex of volume or a large price move on the upside that this downward movement is coming into? And you can see over here we have a large upward candle, which opened at basically 1377.50 and closed at 1391, and it had a volume of around 361,000 shares on the upside and down volume of around 287,000 shares. So from supply and demand point of view, what you can see here is that although the market increased its volume relative to the last pivot near the high where we actually had our sell signal, the volume coming down has still not eclipsed the maximum volume that came up. So if this market is going to really break down below those areas that I'm talking about, that, you know, the 1377 and 1371, we're going to need some serious volume coming into the market. And that volume, you can see over here, there's a big gap between where the current price is. I'm going to zoom in over here so you can actually see this a little clearly. So this is the current price, and you can see between this boundary and the next boundary, there's a big gap. So when we get another sell signal, somewhere anywhere between where we are now, 1394, 1401, and now come back down, and we have a huge downward black bar or a sequence of black bars, meaning downward price movement coming down towards that area. If the volume happens to exceed the volume of that up candle there, then what's going to happen is there's really this entire movement that took us up to this point before big volume came in by a lot of the retail traders. What you will see here is that the volume was very scant. Volume was only 15,000 shares on this up move. It was about 190,000 shares on this up move. So if we do get volume coming in that exceeds 287,000 contracts on the downside within any 89-minute consecutive interval, so basically within an hour and a half interval, and usually, you know, the times to look for that is usually around the European opening session. So, you know, usually sometimes that could either come in during the first hour and a half of trading in the U.S. markets, which are usually quite active, and it also, another time of day to actually look for that kind of volume, be at the end of the day when mutual fund managers try to actually pair off their positions, and they usually do some pretty serious trading, and that's why, you know, it's very important for traders to pay attention to the opening and the close. And what happens in the middle is really not as interesting. Professional traders and investors really focus on how the end of the day and the beginning of the day shape up. And if the end shapes up a lot worse or reverses the beginning, it's telling you that the conviction was weighted on the downside. So that is the short-term outlook on the S&P. Okay. Now, what I'd like to do right now is go to where the real action was this week. And, you know, in our past seminars or webinars, we were discussing that there was a critical risk window that was about to transpire. And, you know, in the financial markets, they're made up of many asset classes. And when you're identifying risk windows, it doesn't just impact one asset class, like just equities. It could be impacting commodities. It could be impacting currencies, or it could impacting interest rates in the bond market. And a lot of things happened this week that really rattled a few of those markets. And I'm sure a number of you have paid attention to some of the serious upward spikes in the yield, in the long bond and the 10-year bond, okay, and 10-year treasuries. And also, if you were paying attention to the currency markets, there were a number of pivotal moves that took place this week. Number one, basically the U.S. dollar is starting to show some serious traction relative to the Canadian dollar. And I do believe that the U.S. dollar is going to gain significant ground. And in the past 24 hours, the market has demonstrated that. And I'm going to take you to that chart right now. And I'm going to go over to the U.S. dollar, Canadian dollar spread. So it's not a spread, it's really a cross rate. So what it's really telling you is that when you see over here on the screen U.S. dollar first and then Canadian dollar second, it means that when you see an upward move in this chart, it means that the U.S. dollar is rising relative to the Canadian dollar. And this happens to be each bar on this chart. So I'll just zoom in here so you can actually see what the bars look like. So each one of these bars represent the range of price that traded within a 34-minute interval. I really could have picked any interval. It just happens to be that in order for you to actually maximally see what I'm trying to look at, based on the range of movement that happened today, a 34-minute time frame best reflects that action. But markets are transient. They change their behavior over time, and it's our job to try to find the right look-back period that represents the market action moving forward. Okay, and this happens to be the right action to look for the short term. And what we see here is that we had a consolidation in the U.S. dollar relative to the Canadian dollar, and you can see the market was kind of selling off, and that would have like made traders think, hey, you know what, maybe there isn't any big move coming. But what you can see over here is the market came down hard, and it came down hard into a downward sloping boundary with a whole bunch of other downward sloping boundaries in confluence. So when price got on the other side, there was nothing but support at that critical level. A note was also put out on Naked Swan Trader, which you can follow on Twitter. And basically, there's a link to that on nakedswantrading.com. And I put out a time-stamped call on this specific trade. And there will likely be more calls put out regarding currency movements in the U.S. dollar relative to the yen, U.S. dollar relative to the Canadian dollar, and as well as the euro, which a lot of people are looking at. But so many people have been focused on just staring down the euro, but there's really a lot of transitions that are taking place, you know, in the U.S. dollar, Canadian dollar, and the yen. So anyways, what I want to show you here is that the market came down to that level, okay, and it came down with some conviction, but then it rallied and came back down and didn't take out the low, and also came into multiple areas of support based on the fact that we had the teal boundary slope down, we had the long-term red boundary slope down, and then price got on the other side of another boundary. So the fact that we had multiple confluence of boundary conditions where, and what does that mean? It means that if each one of these boundary levels represent people's perceptions of zero momentum in the future, that basically means that if it slowed down, if price was just to go sideways, the distance between where price is and where zero is more positive, which basically means it doesn't even require positive news events or positive price increase to reinforce people's perception that price is going up. And that's the real difference between a forward-looking map and a map that looks sometimes backwards. That's definitely not something a trader wants to do. So basically, what happened was at around 7 o'clock in the morning, we broke out of this yellow boundary. And what you can see is the yellow boundary, as soon as we broke out, you can see the yellow boundary sharply starting to slope down in the future. So it means that people are really going to become bullish. You know, a lot of like support is going to come into this market, and also this upward boundary is also sloped down, which means that basically there's very strong support in that 99 area, which basically means any sell-offs that naturally occur into the 99 area, or even down to any one of these boundaries that are sloped down over here, are buying signals that will likely blow through these highs that were made here, and you know, and there's significant opportunity for you know, trend following currencies, because currencies tend to, the trends tend to last much longer because global macro forces and policy decisions tend to move a lot more slowly than people's finicky behavior in the equity markets. Okay. Now, what is this telling us? Well, if the U.S. dollar is rising, that is definitely acting as a headwind on the U.S. equity markets, because U.S. equity markets are priced in U.S. dollars. So basically, a rally in the U.S. dollar is going to make the nominal values of those assets, it's going to make it harder for them to go up. And that's another catalyst that I believe really caused the market to start coming down in a corrective phase. Because until now, there really wasn't anything out of left field. Like, all the news coming out was always like kind of, it's either economic reports that seem to be just manipulated all the time, or talk of more potential QE action or keeping rates low. So there was a lot of things just kind of keeping the market kind of floating up with low volume to new kind of highs with less and less participation by a lot of sectors. And, really what's happened over the past while, and this week, one interesting notion that I've identified this week that's been very different than not just the past few weeks, but pretty much any time in history, is that the Dow Jones Index has almost become its own asset class. And what I mean by that is that its behavior is so much different than how it moves relative to the S&P 500. Those markets used to move together. Not only are they not moving together, but the range in their divergences on any intraday period happens to be extensive. And there's good reason for that. The Dow Jones is made out of companies that are very large cap companies that tend to have a lot of business overseas. Okay, and when I did my analysis of looking at large cap growth stocks compared to what compared to what mid cap value stocks look like, which is where most people are in, there tends to be a great deal of outperformance in large cap growth. And that's just because there's a lot of opportunity. There has been a lot of opportunity overseas, and based on currency movements as well, and also that definitely has an impact on the Dow, because the Dow is made up of a lot of large cap growth stocks. Not only that, but also there's a few stocks in the Dow that I'm about to show you next. I'm about to show you a chart on agriculture, which really indicates a real bull market developing in agriculture. And that's telling us a lot of things. It's telling us that, hey, there's inflationary pressures in the items people need most. People need to eat. They need to live somewhere. Real assets it's telling us they're going up. Bonds this week have really showed a downward bias very strongly, and yields have been inching up. And that's another sign that there's some inflationary winds in the pipeline. And I believe that some of the areas in the Dow, which have made it a very different kind of index than the other indices, and that's why I call it its own asset class, is basically Apple Computer, IBM. Those are once in a lifetime kind. Well, I wouldn't say once in a lifetime, but they're definitely generational type of stocks that they're not your typical stock market behavior that you will find in any other kind of asset. Their market share is enormous. They represent an enormous component of the Dow and the S&P, and really small movements in those specific equities or large movements, as we've seen recently, could really cause excessive overbought levels in the Dow relative to the S&P. But any great trader knows that you really got to look at the broad market to determine the health of the market, and that's key. So at this point, what I'd like to do before I move on, because we were just recently on the chart of the U.S. dollar, Canadian dollar, I'm just going to zoom out for a second and maybe spend 1 minute just showing you the bigger picture of why I think there's a radical shift out of Canadian dollars into U.S. dollars. And what you can see here is that we were base building for a while, going from April of last year into August, okay? And then we had a rally and a nice consolidation. And you could see over here that during this consolidation, and I'm going to zoom in, what you can see is that long-term we have many levels of support on the way down. We also have just recently broke out, as I showed you just before, on the 34-minute chart, and multiple areas of support here. And really, there is no major, resistance until you actually come into the 104 area. So that's a significant trade from a trading point of view. A few cents potential upside is a big deal. Now, when could there be even bigger upside action? Well, we currently have a pivot point, a high that was made at the 106 area on the U.S. dollar on October the 4th. And you can see here that these upper boundaries are starting to bend down in the September through February period. And that happens to coincide with one of those critical windows I indicated in the last call, that somewhere potentially in September or later in December there could be another major volatility event in the equity markets. And this tends to corroborate those facts, because indeed, if we get a short-term up move into this resistance, and then the market comes back down into support, because support we could see all the way into the future. It's down here, and then it just kind of consolidates here, and we get a break above this area, which is right slightly above that pivot point, and that area happens to be the 106.54 area. You get a break above there, okay, and you're basically talking about a huge gap that takes you up to the 120 area, which is a huge downside risk to the Canadian dollar, which also means it's an upside potential for the U.S. dollar. And as I said earlier, a rise in the U.S. dollar is negative for the stock market. But you got to remember, the Canadian dollar is only a small component of the U.S. dollar traded basket. So it's important to see whether the U.S. dollar index, and I believe I showed that to you in the last market call. I'm going to now put it on the screen. It's under the symbol $ DXY. And as I indicated before, the U.S. dollar index has been rising, and it wasn't just the Canadian dollar that it was rising relative to. In the past it was rising relative to the euro, but really the recent upward action was really caused by the yen selling off relative to the dollar. Recently today there was a bit of an upward move in the yen, but I do believe that after that upward move is done, we should resume some more downside action in the yen, causing the dollar to rally, and then adding that component of the Canadian dollar rallying, it should give some more impetus to the U.S. dollar. You can see there's some tremendous support on the downside. We also have a whole bunch of boundary conditions that are just starting. If I zoom in over here, they're just starting to curl down. So basically a price move, and the next major level on the U.S. dollar is between 81.78 and 82.17. We close above any of those areas. You got a huge gap in the U.S. dollar taking you right up into the 87 handle area, okay? And that would rock the markets, okay? So let's now, take a step back and look, let's now go to the S&P on the longer term time frame, because I just showed it to you earlier on the short term time frame. And you're going to see some correlation going on in terms of our risk windows. I'm not talking about correlation that people normally look at, not correlation in terms of returns, and definitely not correlation in terms of backward returns. We're talking about forward-looking risk windows that tell you where the tail events and black swan, even though we don't actually know what the news events and the headlines are going to be in the future. What these boundary levels tell us, and the shape of those slopes of those boundary levels, it tells us how information will get processed and amplified by different traders in different time frames, which basically means that these boundary conditions tell us something about the context and the environment of the market, which is more important than knowing the news. Because a lot of the times you have positive news and a biased context on the upside, and all negative news just gets thrown out of nobody cares about it. and markets keep on moving up and up and up, and then eventually you get to a certain boundary orientation where like everything is sloped up or everything's sloped down, and then it only takes a small news event to really amplify the effect. So we're really looking at how these boundaries amplify the effects of news information and how that leads to volatility in the markets. And that's what I do every single day, and I'm passionate about that. So looking at the E-mini here, you could see that the E-mini recently, when we took out, as I told you in the last week, we took out that that previous high with volume with about 2.7 million contracts, and that previous high was made with around 2.2 million contracts. So we definitely had an extra 500,000 contracts on the upside, okay? And now the key thing is we're getting this downward move. We had about 2.6 million contracts. So it's still a little bit less than the 2.7. If we could, like, on the next move blow through that and get underneath that key level, that you know, that 1366 area, then that would definitely, that could indicate that, hey, we're going to go down to the next area of support, which is the 1344 area. It just happens to be, because this market has been moving up very methodically in a very organized way, it's almost, what it's done is it's built multiple levels of short-term support, so it's got to eat through that support. So you could see here that these boundary conditions all start to curl as you know, they all start to curl into that May-June area. So there could be another big volatility event after this short-term volatility plays out. And then, you know, and then of course on our next market call, if we come down to that critical area, then we could start looking at short-term buy signals that could take us back up to retest the highs. And if it retests the highs on lighter volume than it did on this bar, and this bar had volume of around 1.5 million contracts at the high over there, then basically that would indicate that the market's going to start to fade down again. You know, but we're pretty much playing in that trading range between that 1295 area and you know, that 1424 area, you know, which, you know, kind of projects, you know, out into June. That doesn't mean we're going to 1424, but it just means that, hey, you know what, if we get down to that short-term support, we could get there. If we get there, we'll have a nice sell signal again. Instead of being selling off from the 1408 area down to the 1377, we may have a bigger kind of contraction, you know, somewhere from 1424 down to the 1344, and that's, you know, or 1300 area. And then, you know, and then we could look again for a buy signal. The only thing is, as you get towards the end of the year, you get a convergence where all the boundaries are sloped up, below and above. And that's where the real big action takes place. And then if you actually get underneath 1370 at that time, yeah, you're going to get a very sharp correction into the 1,000 area on the S&P. Until then, it's a lot of short-term trading, and that's why I believe traders should be coming back each week and listening to what we have to say about the next week and the next, at least the next few weeks. So that's the action on the S&P. There was also some, as I was indicating a while back, the transportation index was also showing extreme relative weakness. And today there was you know, some interesting downside action in FedEx, which is a component that impacts that index. And you could also see that very much different than the complexion of the S&P. You could see that the transportation index, as I showed to you multiple times, has multiple areas of boundaries that are sloped up, and a lot of distance in terms of downside action. But you know, intermediate support right now, like really short term, is this red boundary, and we kind of bounced off of it. You could see that we spiked down to it, then we rallied up because it was sloped down. If we do blow underneath that, then the next area of support in the transportation index would be the 5,067 area. And you could see, until all these boundaries start sloping up, we really won't have a really good chance of really breaking down with conviction to the next support area, which would be around 4847, which could happen in the May period. So we're really landlocked between that 5,500 area going into the middle of the year and this 4,800. There's really no upside potential here for a breakout to the upside that's of any value. It would be very dangerous from an investment point of view, and a lot of downside tail risk. But in terms of a sell signal, yes, from a trader and investor's point of view, getting underneath that 5,011 area, anytime in the, in the middle of the year, you've got support at 4,700 going into September. You get underneath that, there's no support. You don't have any support until about 2,500. So that's what I'm really worried about going into 2013. And it could, and for most of the market, it may not start until December. But increasing volatility, and I believe this week started it off, and we were talking about that critical risk window into the end of March, starting somewhere in the end of March. There's another minor window after a retracement that could happen in mid-April, and then the really big one for many asset classes, where almost all sectors of the S&P show some real trouble in terms of how information will get handled if negative news headlines come into the market. So you really got to understand how uncertainty could impact the market to a different degree at different periods. And I do believe that that May period is the key period. So we should just brace and hope that we do not see some really, really negative news coming into the market during that period if you're a long investor. Now, if you're a short investor, you should be hoping that negative news comes in, because that will really kick off some very nice short-term action. Okay. Now, what I'd like to go on to is what I talked about earlier in the show, and that is, where is the next big trade? And not just a trade, but also for investors that are really thinking about, hey, you know what, I want to get into an area that makes sense. Okay, well, what is getting into an area that makes sense? Well, think about it. The world is growing. We know that. It's the same old story. Okay, but yet Apple is the only thing that goes up. People still need to eat. Why is it that when I look at my charts, that everything that has to do with people eating happens to have a buy signal setting up? And what I mean by that is Latin America, Brazil, huge exporters of agriculture. They're all showing that they're coming down to some key support areas, and if they break some critical areas, there's some upward movement. It just happens to be that the critical window for opportunity on the upside for those emerging markets that are heavily placed in agriculture happen to also be correlated with the specific opportunity windows for what is going to transpire in the grain markets, agricultural markets, also fisheries and farmland. These are all real asset classes. This is telling us something. It's telling us that, you know what, I would rather not chase yield in paper. Like, a lot of people today are getting the wrong idea. They're seeing that there's a chance of inflation, so they have to rush and try to find the next best equity, like an Apple, in order. Apple is a great company, but its price, from my point of view, anything above 575, it's in a bubble. Okay, and yes, I do believe fundamentally it's strong, but it's going to have its corrections, and then there'll be a time to get in. This isn't not the time. It also doesn't. It isn't an item people need in order to survive. You definitely need to eat. So let's now go to a commodity ETF called the DBA. Okay, and the DBA is basically the PowerShares DB Agricultural Fund. It traders that aren't trading in the futures markets and who have equity accounts to actually participate by just going long this ETF, and it gives them, full exposure to agriculture. Now, I have to admit that I have not been very impressed with a lot of ETFs that have come out in the past year. There are many ETFs that have come out that have very low tracking with the actual index that it's trying to follow. And those are ones you want to steer clear of. Okay, but I'm not going to show you any of those. I only pay attention to ones that, if I have a good investment theme, I want to find an ETF that tracks that theme dead on. And for traders out there that may be exploring their own ETFs for their own trading ideas, some of the key things that I would suggest that you look at is you should tear apart what the components are of that ETF, so you can make sense out of what exposure that ETF actually has to the operating costs of running the businesses that are in that agriculture space. Because if a lot of the ETF is weighed down by input costs and isn't really tracking the underlying commodity, then you're really not getting exposure to the commodity. And there's a lot of them that actually will fall when the commodities are rallying, thinking that you're actually getting exposure to it. So that's key. The other key thing is if there happens to be an exchange-traded fund, as opposed to an exchange-traded note, okay, that happens to be an ETF that tracks a theme that you're looking at, then you should always focus on the one that's the exchange-traded fund, okay? And the reason why I say that is, number one, there's more liquidity in exchange-traded funds, and two, you don't have counterparty. There happens to be risk, but because an exchange-traded note has to be basically there's credit risk by the company that's backing it. So you also have to understand which bank is backing it, and then you have to also believe that they're going to be credit worthy. That's just too many things going on over there, and you're really no longer really exploring possibilities for leveraging into a trade that's tracking the commodity. So right now what I'm showing you is the DBA, which is the Power Shares DB Agricultural Fund, which acts agricultural commodities. Okay, and even better than that, it has a setup for a very nice buy signal. Does that mean you just go in and buy today? No, you don't have to, because if this is going to be a real move, it should break some key levels with some real volume and some real conviction. And what you see here is that this is the kind of thing you should be looking at. You shouldn't be looking at an apple that's rising and now thinking about getting in. You should be looking at that areas that people need that have been selling off because too many people have been chasing yield in paper assets and not real things. And what you see here is that, yes, there was a lot of volatility. But you know what? We weren't in it because we actually, it said to avoid going in. And not only did it say to avoid going in, we actually had sell signals up here. We had multiple confluence of boundaries sloped up, huge gaps to downward boundaries. And now finally, after a consolidation, we were able to slope those boundaries down. So it's time that bends people's perception. So it is true that time does heal a lot of things. It even changes people's minds. So the point is, when the market came down over here initially, it came down with 2.7 million shares. When it came down in December and retested lows, it came down with 2.4 million shares. Less conviction on the downside. Good thing. Then the market rallied back up, came back down, but failed to break down below that low. So when it did come down, what I'm looking for is these black bars. How much down volume was there compared to the up volume that there was as the market came off the bottom? So if I look at this, we came up with about 1.1, a little over a million shares, and came down with 2.1 million shares. So we came down with conviction. Some people would say, hey, coming down with high volume is negative. But it's not negative if you come down on high volume and fail to take out the low and then reverse. And what happened is, yes, we had high volume. Then the market reversed and then came down again to retest that low. And this time it came down with 672,000 contracts, closing at 28.34. On this low, it closed at 28.39. So we only went a few cents lower, but no new buyers were able to come in. It was such a small amount of, no new sellers were able to come in with conviction. Only 672,000 shares compared to 936,000 shares, and compared to 2.1 million shares as it was pressing into the low. That is a sign of a market that is giving up its ability to sell off. And on top of that, we have corroborated evidence by our forward-looking zero momentum points telling us that people are going to begin seeing news of any kind, even slightly positive news, as really positive with just some small movements in price. And and there happens to be some very nice support in that 27.76 area to the 28 area. And 28.34 is awfully close to those areas considering the amount of upside action we have if we move towards those upper boundaries where there's resistance at 34. That is the kind of trades we're looking for. And it's also the kind of trade that shows relative underperformance of this specific asset class relative to some of the asset classes that have been in vogue recently. So where is the specific catalyst price level for this thing to really take off like a rocket? okay, outside of some short-term action that, there's this little pivot point here. So taking out, basically, well, there's some resistance in 28.36. But let's not talk about the short term. I really want to talk about for how traders and an investor could just buy into this and really watch upside action. So what we'll do is we're going to zoom in over here to this upward pivot point that we just recently made. And what you will see is that we made a recent high over here at 29.50. The last high we made was 29.53. So we almost took out the high. This last high was made with 818,000 shares. The reason why I'm not looking at this high and it has 1.2 million shares is because it's both made up of up volume and down volume, because this happened to be a down day. I want to look at when there was conviction to the upside and what the volume was. It was 818,000. When the market actually made a new attempt at the high, it went up with 843,000. Slightly more volume, but still no conviction to blow out that price point. Then the market came back down. Now if the market comes back up, and because it's consolidated and came down with no sellers, now the market turning back up is not only going to bring in the old momentum buyers, but it's also going to bring in the buyers to sell off. So smart money can now come in and give the catalyst for volume to take out this high. And what is the price level? The price level is 29.76. That's like the big level, okay? Now, that's not that far away from 28.34, okay? It may take a little time to do it, but this is a this is a trade that's there. There's not very many indices today where I could actually show you, such trades developing that are linked to, to real things happening in the world. Real asset classes going up, real areas of the economy that need food. You got Latin America, you've got, a lot of the China and the developing world that actually requires these kind of commodities, population growth in those areas. So there are a lot of fundamental factors that go along with some of these structural levels that we're looking at. Now, when we do get above those areas, what's going to end up happening, the mathematics of how this model works, and it's kind of interesting. And I'd like to just relate an analogy to nature, because I think this really explains how the market actually functions as an organic system. And when I say that, what I'm saying is that no one time frame or one trader group is more important than the other. There is harmony among those groups. When one group of traders move a certain way, it influences how other groups behave depending on how those levels were positioned over time. And when price does indeed get over that 29, 80 level, 29.77 level, it's okay. So we're talking about a close above that area. We get a close above that area on that volume, and then basically what's going to happen is price is going to start gapping up very dramatically towards that next boundary of 31.26. Okay, that'll be the first level. Okay, but in the process of getting to that level, we now have a whole bunch of support above us. So we're going to, the support level is going to now rise to 29.96, and then we could take a lot of short-term trades, and we will be updating you in future calls if we do end up breaking above this level, and we should have some great trend following opportunities over the next number of months and years to come. And what's going to happen is when you break above this purple boundary, it's going to cause this purple boundary that's already started sloping down. It started sloping down because price stayed down below it long enough for it to slope down. But once price breaks out with volatility on the upside, it's going to cause this to even move down even more sharply, which basically means that short-term action and extreme events will start influencing the ordinary behavior of the market in the future, because in the future it's telling us that other traders are going to be now seeing things differently just because of the short-term action. So, and it's the short-term action around volatility points that causes those changes. So going back to the idea in nature, it's the things you can't see that are important. A lot of people focus on identifying patterns in the market. Patterns are things that people see. The problem with it, they see things that aren't there. Now, if you assume that the real important information is kind of between the lines, it's in the spaces where you don't actually have zero momentum points. And those big gaps, that's where the action takes place. And that is what influences the shape of these boundaries in the future, which dictates people's behavior in a forward-looking basis. And that is what we want to track. So we are reactive to the market in the sense that our boundaries react to current price action, but we're also proactive in the sense that we could already see the shapes of different time frames and how people will perceive and act on information in the future. And if we could stack up those orientations in a certain way, it's almost like a domino. All the dominoes are lined up and separated just the right way so that if you just tip it, it falls apart. In real life, if you separate dominoes by about 20% of the separation of the height of the domino, that will give you maximum impact. It's the same thing in the market. If the boundaries are separated by a certain ratio and the distances between them are expanding, that's where you get those large volatility events that outsiders later on say, hey, that was a black swan. But in reality, it was not. And this whole analysis that I'm talking about is what's called bottom-down analytics. And that's the core of our value proposition and how we actually look at the market in a different way. So far we talked about the DVA. So now let's talk about Brazil. So I'm now going to go to the ETF that represents Brazil, which is the EWZ, okay, or EWZ. And basically, what you will see is that we are on some very, very heavy, very different than what the Dow looked like, right? You can see that we're coming off of a bottom, all kinds of boundaries above us still starting to slope down as opposed to transports, which are completely the other way. And you can see here we've got this black boundary that is sloped down very, very, very nicely. This other boundary starting to slope down. We're above this green boundary offering support. So, so basically we're in this trading range over here, and then breaking out above there will take us above this area, and then basically we've got, 81.37. Huge. That's huge upside potential. And why is it that there's more upside potential in Brazil than there might be in the DVA? Because the DVA tracks an index, and equities are leverage instruments that have high beta relative, to the movement of a certain space that influences that country. So agricultural commodities going up would have an amplifying effect on the value of Brazilian equities. Okay. Now, in the event that the market is just has a catastrophic drop in May or later in the year, the nice thing about this as a trade is that you could see here we've got firm support that goes right into the end of the year at that 54 area. Now, yes, 54 is a big distance from 65, but there's a big difference here that when you've got support, all the market does, what's going to end up happening is that this area, it's going to just be the bigger consolidation. All these boundaries start sloping down. Then you break out of there. Once you break out of there, all the other boundaries here are now sloped down forever into the future as far as we really care looking, which means that sky's the limit in terms of Brazil, on any kind of upward action in commodities. And also if people have to be exposed to the equity market as part of their allocation, it makes sense being exposed to those areas that have the potential for large upside growth and a quick reaction to upside movement coming off of prolonged risk events. And that's the key potential for making money right now. What they don't look at is if the market goes the other way, is that index ever going to recover, or is it just going to be underperforming for an extended period with no real hope when the next asset rotation takes place? You want to make sure that if there is an extraneous event, and extraneous events and uncertainty exists in the market all the time, certain things can't be predicted. But one thing we do know is that we could set up trades such that when uncertainty and unknown events come, traders' responses around those critical um, zero momentum lines will result in very quick, smart money coming into the market and allow for a quick recovery off of a low, which means that people are positioned for the next major cycle as opposed to being in the next major cycle in the wrong asset class. And in the event that everything works out as expected and positive events take place, then you're making money right away, as opposed to not making money and not making money in the long term. At least you have it lined up, you know what your risk levels are, and you can participate in the upside. So that's the Brazilian index. The next area I would like to really talk about, there's two areas, and they're again related to the theme of real assets going up, and that's that's probably playing into the fact that there's some inflationary pressures that are going on in the Treasury bond market. Okay, and so excuse me, that area happens to be steel and coal. Okay. But I really just want to focus on, I don't want to focus on too many things today. We will revisit these other areas in our next call. I want to focus on U.S. Steel, because U.S. Steel is one of the older stocks with a lot of history to it. So and as I told you in the past, the more history a stock has means there's a pool of investors that could look at the market in different ways, because there's more ways to slice and dice a specific stock if it has more history. Somebody could look back and say, hey, the last 5 years is important, and they could make an assessment based on that. Somebody could look back 20 years. The stocks that only existed for a year, there's not as many people that are participating, which basically means that there's not as many confluence lines that we could look at that's offering support or resistance. So U.S. Steel is definitely great. It goes back many, many, many decades. And what you will see here with U.S. Steel, it was definitely not loved, for a period of time. We kind of made a short-term high into, that February period. If I zoom in over here, what you will see is we made a high at $64 in February the 18th, 2011, and we made that high with around 9.6 million for 2011 when the market kind of bottomed out, and shares. Okay, you have to go back to that lower low that was made, that it was gunning for, that 2008 low, and volume there was 17 million and 13 million and 14 million. So yes, it did. It actually did come down with some, some serious volume in that period. But what you will see here recently, the market has now retested. It's come back to retest the low. Okay, and came down with 18 million, and then lighter volume, downside action, about 17 million and 18 million shares. So what it's showing us is there's smart money that came in near the lows, which is what we want all investors. Now, a lot of people say, oh, it sounds all easy. Buy a low, sell a high. It's quite simple in the context of the tool that I'm looking at. Because to me, things are cheap when we're below all the boundaries and all the boundaries are sloped down. And if we're above all the boundaries and they're all sloped up in front of you and going into the future, visual perspective of what is cheap and what is not cheap, and what assets should be sold and paired off and which ones should be added to a portfolio. U.S. Steel happens to be one of those names that I think could become quite interesting if certain critical events take place. Okay, and those critical events, but it's very hard to get the underlying structure of the market oriented across so many time frames in such a way that you even have the potential for a critical event. So that's why we're looking at those things. Okay, and U.S. Steel, what you will see here is it rallied up over here with 11 million shares. It rallied up over here with 17 million. It came back up, retested here with 19 million, so it took more volume. It's now retracing, okay? A whole bunch of support on U.S. Steel at the 25 area and the 24 area, tons of support. Even if prices don't go down, okay, or don't go up, just going sideways will cause it to get on the other side of this blue boundary or navy boundary, which happens to be sloped down. So it's going to actually find support just by buying time. So it's interesting, again, how time could change the perspective of where support and resistance is, even without new market information coming in that most people are familiar with. People think you need to have transaction buying and selling volume to tell you how new pivot points are going to form. But these invisible boundaries, which don't show up in price charts, actually tell you something about the underlying behavior of what volume and volatility could look like as you're going to push through some critical pivot points. And the point that we're eyeing here happens to be that 33.23 area. And especially, you know, from there we should get a quick rally to 37. When it gets to that area, close above 37, that becomes a long-term buy signal. There's really no resistance into 63. So, you know, we're talking, you know, potential doubling in certain, you know, that's inflationary. Just the prospect of even having such gaps by having such small movement in the upside, you know. And even if the market was to completely crash, you know, in May, even with all these support areas here, you've got, you know, you've got this long-term support, you know, in the 17 area, which is the same area that we were already at. It's actually a little bit above that low that we were in October. But the difference now is in October, we didn't have that much support, right? In October, we basically only had 1, 2, 3, 4 boundaries of support. And those were short-term boundaries. Here, we've got a whole bunch. We've got long-term boundaries. And when you and if you were to come down over here, all these short-term ones will start sloping down in here, and then you would end up getting a buy signal. So those are the two things to look for. If you don't take out this upside right away, and the market comes back down, if in the event that the market corrects hard in the transports and the S&P at some point in May, and it comes down to this area, then you want to be thinking about buying in that, you know, that 17, 18 area. Now, of course, each week I'm going to be analyzing this in the short term so that if there happens to be short-term buy signals that come in anywhere along this blue boundary, then we'll have an opportunity to go long and have a chance to break out of this upside. But, you know, the key thing is, if it's all about the shape of these boundaries. So in the event that the market was to kind of get on the other side over here and these boundaries all start sloping up, then it's going to be, you know, then you're basically going to have to just wait until these boundaries slope down again. And you could see here, we would then get on the other side of this black boundary, it sloped down, and then we would, you know, then sometime in July, breaking above 32.50, which is the same level again. It's just a different time period, and then you get the rally up. So the thing is, there's multiple attempts and chances for a breakout on U.S. Steel. And I just thought that it's important to take a look at that, because when I look at a lot of the other indices, I don't see any potential trades on the upside. And I don't care whether it's a potential trade on the upside in the short term or even 2 years out from now. There's just nothing there. It's just very, very dangerous from an investment point of view. And from a trading point of view, I would just rather be focusing on markets that happen to have the long-term trend in the direction of that movement. So the next thing I'd like to talk about is a spread trade. And an interesting spread trade in agriculture, okay? And I don't know, it's not really a conventional spread. It's really kind of more like a relative value play. It's like saying, hey, if agriculture is going to do well, then what stocks might do well, okay? And you would think, well, you know, if grains are doing well, and I'll give you an example of what grains I think. Like if, for example, I'm going to take you to this chart. This is rough rice, okay? It happens to be an agricultural play, right? I mean, and the sad thing about it is rough rice happens to be one of those basic necessities needed in the developing world, and if those things are getting more expensive, not only is it an inflationary thing, but it's also it's a sad picture for developing nations that really need these goods, and it's going to be harder and harder for them to buy them. So there are other ramifications outside of just the money aspect. So, so that's why I think it's very important to focus on this. And like I said, when you're first looking at, getting familiar with these charts that I look at, you could just kind of think of them like weather maps, isobars of zero momentum instead of isobars of zero pressure or equal pressure. And you can see again, prices are below all the boundaries, and we have a confluence of boundaries that are now sloping down. And you can see over here, all these are sloping down. And you can see here, we have, and by doing that, it's banging into those boundaries. And as you bang into those boundaries, the short-term boundaries start sloping down. So the action of volatility creates those ordinary events that impact the future. That's what we mean by, focusing on those 1% events that cause those big downdrafts. Set up the stage for your normal trend following events that could actually lead forward into the future. And right over here, it's interesting because this consolidation, if we take a look over here in rough rice, and this kind of plays into the DBA, it all looks kind of like the same, is like it made a high at with 14,000 contracts. Here it's made a high with 14,600, more volume. And now if we take out, 1480 area, and especially taking out the 1540 area, huge gaps up to 18, and there's really no resistance until you have like up till 19. That's a huge move for rough rice. And it's all about volatility. That's in a short period of time. And like I said, if you go up in a very fast, it causes these boundaries in the future to all slope down even more so. And then that's what, momentum begets momentum, and that's how you form a trend. So, instead of backward looking is like, oh, let's look at what price did last week, and then let's see if volume came in. That's important just to get an idea of where the markets come from, but really it doesn't tell you about what the volume in the future is going to be. So what comes before volume is people's perceptions of momentum. And the fact that we could actually see zero momentum means that not only do we have zero lag in our momentum indicators, but we've got negative lag. And I don't know of too many indicators out there that I've actually come across that actually give you negative lag, that actually is calibrated precisely to zero momentum levels. Okay, and that is one of the biggest upsides of using bottom down analytics. Okay, so that happens to be rough rice. I could go to I could just show you commodity after commodity. It's showing the same kind of thing. I'll take you to wheat right now, which is another commodity. And what you're going to see here is, again, wheat has been in a tremendous sell-off, from the February area. It's doing, but wheat even looks more like intense, because wheat, you can see here, the black boundary is now sloped down. All these boundaries here. So even if this market turns down here, it's going to just run into support. It just means it's going to consolidate, and then once it consolidates and gets into this boundary, now you have even a longer-term boundary acting as support. And then as you knock into support, it causes these upper boundaries to slope down, which makes it more bullish. And basically wheat getting a close above 701 and 4/8, you get a big gap, first level gap to 838, and then you'll probably get some kind of short-term retracement at the 903 area. You bust out of that area, in the summer or the fall, and then you could easily go into the 1034 area, okay, which is like the $10 area. To really get a long-term, and at that point you're going to have a short-term sell-off into support. You can see these boundaries starting to slope down, so you would get a retracement into about the 917 area. Then all these boundaries start sloping down after December. So basically you get above 1094 on wheat after December, and sky's the limit. You can see $20 wheat. And that's a long-term play. That's telling us 2013, 2014, 2015, massive inflationary pressures in the things people need. okay, if those critical levels are taken out that I identified. And that is absolutely telling me that investors want to be focusing on the next big revolution, which is going to be agriculture, okay? And that is the DBA, as I indicated. That kind of is the complex of all those things. So if you aren't involved in the futures market, you could get that exposure through there. And as you could see, because the risk windows look the same, let me just go back quickly to DBA. You will see that it looks somewhat the same in terms of the fact that they're consolidated after a prolonged risk event. So therefore, they happen to be tracking each other in terms of the risk windows. And tracking each other in terms of the risk windows means you're going to be tracking yourself in terms of future performance cycles, which is exactly what you want if you want to diversify and express your ideas in the best ways. So, so back to the spread. So what would people need? Well, think about it. You would actually need tractors. So Caterpillar and Deere Company would obviously be companies that would benefit from this agricultural revolution. So why don't we take a look at a chart of Caterpillar, which happens to be in the Dow, and then let's take a look at a chart of Deere. Okay, and interesting. Caterpillar, it seems to be at the top. This is not, that's exactly what I mean by a risk window that is not expressing or tracking the views of what we're trying to look at. So something else, there has to be something else going on with Caterpillar that's stock specific, or the fact that its internal structure coming off of the October level up to now has oriented a lot of these boundaries to have a lot of resistance just above us. This does not look like a trade that I want to go long in. I want to look at trades that are below these boundaries and everything slowed down. So this is a trade that not only does it look like I don't want to get into it, but it looks like a trade that I would want to short against a trade that I would go long in the same index. I wouldn't necessarily short this independently, because what ends up happening is a lot of times stocks that are underperforming before a big breakout in the underlying commodity will tend to just go along for the ride, even if they're not the star performer in the next cycle. So let's take a look at Deere, because Deere happens to compete in the same space. You're going to see a very different picture of Deere than Caterpillar. And that is kind of what we're looking for. We're looking for positions in certain assets or equities that best express and track the theme that we're looking at. Now, this is still not quite the same as being at the bottom, but it's a lot better upside than it is for Caterpillar. And why? Because at least over here, we had a nice correction where Caterpillar was just pouncing up at the top. There's a large spread to the top. Like we have a spread that could take us, major long-term resistance is 100, which is 20% and higher. And if you go to, and even if there's, even with the short-term action in the equity markets, if with a correction that could happen into May or in May, there's still a lot of support at this area, which is still well above that low. Where the same thing can't be said with Caterpillar. When I put Caterpillar up, you're going to see you don't have that wide price spread for upside potential, and you have more downside action to support. So I'm just going to put it up one more time so you could see that. So that would be an example of a trade where that once DBA breaks out, Deere looks like a better opportunity than Caterpillar. And you can see here, there's really no support until all the way down here. That's a much bigger distance. That's like a distance from 106 to 76. A lot more downside action. So the key thing is you always want to focus on the equity that has less downside action for market unknowns in the short term, and also that you've got downward sloping boundaries and confluences of them such that when the market flips around, it will be the first one to recover with wide price spread and large upside potential, which Caterpillar does not have, but Deere does. So that pretty much sums up that spread trade. If I just go back to the silver and gold again, just I don't want to go into too much detail there, but basically because of the expectation that the U.S. dollar is rising, and that is putting pressure on precious metals. Okay, and precious metals tend to sell off with a rising U.S. dollar outside of a massive catastrophe or inflation event. So far, we haven't broke out of those critical areas, but down the road, when if inflation does rear its head, then yes, that is where gold, will become a proxy. But the key thing about a spread trade is we don't really care which direction the market moves. The idea is which market is moving relatively faster than the other and which ones have greater distance or downside action. So again, if I just put up silver, I'm going to put up silver futures for a second and just quickly just show you the context of silver relative to gold and why it looks like it has better potential once inflation rears its head. Here you can see silver. It had a major downside event, huge volume, right? Going in October 23rd, volume of 120,000 contracts, 112,000. It doesn't sound like a lot, but silver is a thin market. That's a lot. And then market retested the low with only 58,000. So that was the first signs that, hey, you can't break them, so you then rally them up, okay? Markets just like, they just like testing to see how low they could go based on volume if nobody's there to knock it down. And there really wasn't anyone there because once price got on the other side of this green boundary, we had multiple areas of confluence with heavy support very nearby the price level that we breached. And now we've kind of rallied up. The U.S. dollar is now starting to rally, and it happens to coincide with that sharp down move that we've had in the past little while here. But you can see there's a lot of support right in this area, in that 26 area. Okay, a lot of support in there. Okay, key support and even longer term key support in that 2460 area. Okay, and you could see in the future huge upside once you pass. You could see this downside action. Like I said, volatility events in the present cause future zero momentum lines to start bending down, which is what creates the ordinary events of the future. And the ordinary events happen to be big trend following events on the upside, which with first line potential to 45. That is what I call upside potential. And once, so really the next big event is a close above 37.44 in silver, after the May 22nd period is the catalyst for that situation, for people that are thinking about directional trades. For people that are thinking about spread trades over the next number of months and years out, then it makes sense to be, thinking about being focused more on silver and less on gold. Even though silver tends to be less liquid, if your holding period is to hold this as an asset class, then it really doesn't matter because you're holding it for a long-term period and liquidity doesn't become an issue. So now you're going to see gold. I'm going to put gold up, and you're going to see a big difference. You're not going to see that big price, the same kind of price spread, and you're going to see more downside action. And you're going to see that we didn't consolidate as long near the bottom, and we were more hanging up near the top. And if I take you to gold right now, which is coming up in 1 second, okay, so here's gold. You can see that we didn't have that same consolidation. Price came down here, the silver was already down, and that pivot point happens to be up at the high, so that right now, even if gold tried to move in lockstep with silver, if there was any kind of bullish movement, you can see there's a whole bunch of upward boundaries. Remember, this teal boundary was completely sloped down for a buy signal on silver for breaking out of the last pivot. Here, it's sloped up. So gold, really needs some kind of major catalyst to get it above 1900 before it really becomes, just a performer. Right now, it's an underperformer. Okay, and albeit that silver and gold will underperform when the U.S. dollar rallies, but it just happens to be that there's more tail risk and it's more lopsided, downside risk to upside risk. So I prefer silver. Okay, so that pretty much highlights what I really wanted to talk about. I guess there's one other thing I want to throw in. Global water resources is another hot area, and the symbol is PIO. I do believe, just quickly, that happens to be another area, tied to, that it's definitely a real asset. And what you could see here is that there's plenty of downside support in this area, like in that 16 area. So, like a dollar below us. And then what happens is you can already see these boundaries are starting to slope down. And that's really bullish. The fact that they're sloping down even before a long consolidation or before a downside volatility event is telling me that it won't take, it won't take that long, if there isn't a big downside event here, to cause all these boundaries. This boundary sloping down. Soon this one will be sloped down. So sometime, when you look at it from this perspective, if you actually get out, get above the 1875 area, you got a nice gap to 21. Now, if that doesn't happen, prior to April 9th, then we'll have to just wait till these boundaries start sloping down, which comes, in July, and then you'd have to close above 1849. After that, we've got a huge gap to 21. So I just like looking for trades that happen to be coming off the low, consolidations, and wide price spread. So that pretty much summarizes what I wanted to cover today, and I look forward for everyone to attend the event next week, which we're going to be holding at the same time. Thank you for attending today.